I think the combination of the extent of the slowdown will be important, and the fact that we have had such significant financial conditions tightening, way more stronger than the hikes so far. That's where I think the key risk factors will approach. In our view, hard landing risks have increased quite significantly, so we are more in your camp, in the sense that recession risks are going up because the sensitivity of the whole system in a world which has a lot of debt is much higher to increase interest rates. We've already seen the ECB kneeling down to these balance sheet type of issues with the scenario where we will have hikes and some kind of QE. I think there is a limit to how much the Fed can do as well. But the recession risks have certainly risen, and it's going to be a very hostile environment for risky assets so far.
Where we are at the moment, Salman, tell us where we're going to be in 6 to 12 months' time, because at some point there will be a moment when markets will stop falling and levels will stabilise. When does that come? And at that point, how far will markets have fallen?
So, Jeff, it's a very important question. That's the kind of questions we are discussing within the teams and with our clients as well. So just to give some context numbers, peak to trough fall in equities in recessionary periods since post-World War II is around 25%. So we are starting to reach those kind of numbers. But in balance sheet type of recessions, we are talking about 40 to 50% fall in equities. So now, standing right now, given the slowdown in the pipeline, given what we have seen with the Fed and the very strong hawkish punches going on, we will have to now make a case that this is going towards a balance sheet type of recession to make a case for another significant amount of correction in equity markets. So those are the kind of balancing we'll have to do, because a lot is in price already. But at the same time, the hostility of central banks continue because the current data is not giving them space to show some kind of leeway to the market. So we are passing through this very intense period, and our view is that growth concerns will start to dominate inflation in the next few months.